Hey everybody, welcome. We're gonna let everybody keep filtering in. So we're gonna go ahead and mute ourselves for a couple minutes, but we'll kick it off in 2 or 3 minutes. All right, guys, welcome. There's still quite a few people filtering in. There's a good amount of you on already, so we'll go ahead and get started for the sake of time. And as people join, they're welcome to hop in. So welcome to our event this evening, Financing for Real Estate in 2023. We're stoked to have you. We have our preferred lender, Reed Hazard, here tonight, and a presentation full of really awesome, valuable updates that I know you guys are going to get a lot out of. Just a couple quick housekeeping items before we jump in. We have quite a bit of content to cover tonight, so out of sake of time, feel free to type in any questions and submit those, but we will get back to you. Reed will answer those directly tomorrow. We probably won't have time to cover them live this evening, so feel free to still send them, or you can send them directly to Reed as well. And the other thing I wanted to say, this is a little silly, I just adopted a dog last week, and she's occasionally just randomly starts barking. So she's in the living room. Hopefully she'll be quiet, but just wanted to give you forewarning in case you hear a dog spaz out in the background. So with that said, let's jump in. Reed, can you hit the next slide? I think I froze myself.
Totally.
I don't know what happened. Oh.
You're trying to pop out real quick and then do it again.
Okay. Sorry, guys. Technical difficulties. Let's try that again. There we go. All right, guys. Sorry about that. So Marshall Reddick, we are a company that has 4 different facets. First and foremost, we are a real estate brokerage. A lot of you came to us for that. We help our clients buy and sell real estate, both primary homes and investment properties. For clients coming to us for investment properties, most of them are doing long distance investing and also don't want the legal exposure of self-management. So we are a property management firm as well, with full service in all of our primary markets. We're also a private money lender. So we have clients that come to us and borrow for a variety of hard money loans, private money if they don't qualify to go the conventional route. Reed will get into that later as well. We also, on the flip side of that coin, have investors who individually fund those mortgage loans that are run through our private lending department. So on our website, you can see a real-time mortgage marketplace that looks different depending on the time of day. There's always investors coming to us to borrow and other investors funding those loans to make money as well. And last but not least, we are also have our Marshall Reddick Mortgage Fund, which is, if you are an accredited investor, this is an amazing vehicle for wealth building and very hands-off once it's set up, and really strong historical performance. This is a really popular option as you're saving money and setting money aside for your next real estate acquisition. So we're not a one-trick pony. We have a lot of different ways that you can be involved. So I know a lot of you that are on the call tonight, but for those I haven't met yet, I'm Rachel. I'm one of the advisors and agents here on the team. A little bit about me: I was born in Seattle, moved down to run away from the rain when I was 18. And there I went to Vanguard University of Southern California for college, got my BA there, and eventually got licensed as an agent both in California, and we actually moved out to Texas almost 2 years ago now. So I kept my license in California, but I'm licensed in both states to help clients. Also been an 11-year Marshall Reddick client myself, my husband and I. So we were investors for years before I joined the team. And all four of the facets that I discussed in the last slide, I'm an investor in as well. So I can talk to you about any of those. It's something that has done very well for us, and really love what we're able to offer our clients. And then as far as what I do, obviously with advisory capacity, but I also help our clients with single family, multifamily, with primary residence, investment property purchases in all of our markets nationwide. And since moving to Texas, I've actually also helped a lot of people relocate from California too. So that's an area that I love as well. All right, so where are we located? The green highlighted boxes are considered our primary markets. So we are in 16 major metropolitan markets across 8 states, but the green boxes are considered our primary markets, where we have our offices and our teams located as well. All right, so a lot of our clients come to us, and when I do these initial advisory consultations, people will ask, like, well, how did you guys come up with these areas? So since we were founded in 1979 by Marshall, originally we've sold real estate in over 200 US cities, but through that we learned what worked, what didn't work, and we handpicked, when our CEO purchased the company in 2012, we really handpicked the most prime, strong markets that have performed really well historically. And these are the 7 areas of focus we really narrowed in on. So a really strong job market, that's super important. A low vacancy rate with the investment properties. We want to take a look at that performance as well. Economic diversity, that is huge. You want to make sure you're not too dependent on any one facet or industry. You want to have a lot of diversity, so your market is strong regardless of fluctuations. Housing affordability, that's a big one. You see a lot of our investors coming to us from coastal markets, such as the East Coast or West Coast, where housing has gotten really unattainable, and they have this money that they'd like to put into real estate and protect and grow their assets, but their home markets are a little more expensive. So housing affordability is a great thing to look at when it comes to investment properties. Is the market landlord friendly? This is huge. In all of our non-California markets, this answer is a resounding yes. The laws are very much in favor of landlords. They're structured to support and protect landlords, which is really ideal when you're owning an investment property. Is there a strong education base and a lot of strong schools? That's important. And last but definitely not least, reliable property management. That is crucial. You want to make sure you have a company that you can trust. There are a lot of shady ones out there, and that is definitely not Marshall Reddick. I know I talked about this earlier, but I actually am a property management client as well. And I always joke, we don't get employee discounts. So I pay what my clients pay, and I do it happily. They're phenomenal and have done a really good job with our properties. All right. So real quick before I make the introduction to Reed, why does lending proficiency matter? It matters so much. Your lender is going to make or break your deal, whether you're shopping for a primary residence or an investment property. It's crucial. I always tell my clients, I do practice what I preach. Like I said, I've invested with Marshall Reddick for 11 years. I've done 5 loans with Reed. He is phenomenal. He and his team are incredible. And my husband and I are not an easy file to underwrite. We're both self-employed. It's actually kind of a nightmare, and they make it as smooth and seamless as possible. They're wonderful. Reed and his team, like I said, they are top tier service. He has an amazing team of underwriters and support staff that make sure it's smooth end to end. And I have helped at this point. I've sent Reed hundreds of clients. All of our agents nationwide do so as well. He helps thousands a year. And only literally one time have I been able to see another lender beat Reed's rates. He's extremely competitive and his service is unparalleled. So, and that was a builder that had a crazy promotion going and just one time. But that just goes to show we do have clients that have shopped around and Reed he's untouchable. So I have had multiple clients a few times, thankfully not too many, but probably I could count on one hand how many times I've had clients that insisted on working with their own lenders. They're like, no, this lender is phenomenal and blah, blah, blah. Well, push comes to shove. They weren't fully underwritten and the deal fell apart like right before closing. The client was going to be out the earnest money. It was just, or their, it was going to be a mess. But Reed has come in and saved deals so many times for across the company. But yeah, that's happened with me a handful of times as well. So I always say like it really, your lender is arguably the most important part of having a successful deal. A close-knit team is super important. Like I said, Reed and I worked together for many years. He works in the trenches side by side with our team. He's, CMG is not directly affiliated with Marshall Reddick, but they just offer such superior and untouchable service that the overwhelming amount of agents really encourage all of our clients to work with Reed because everybody walks away really happy. Just read his reviews. Reed's also, as you're about to see, like a mini economist, and he has experience with a ton of different lending products, including very like specific niche ones like VA or, just many, many different products that he works with. And he has a long running relationship with Marshall Reddick. So if for any reason a client didn't qualify to go conventional, he has a strong relationship with our private lending team. So all that goes to say, Reed is the best in the business. I'm really excited to hand it off to him, and I hope you guys enjoy his presentation. So with that, Reed, I'll turn it over to you.
That was such a nice intro. Thank you very much, Rachel. I greatly appreciate you, and so happy to be doing this with you tonight. And hey, everybody, thanks for being on the call. Wow, it's been such an unpredictable market so far from an interest rate standpoint. And tonight will be super fun. So we'll dive into quite a few different topics. Just a couple things about me, kind of like Rachel said. I live in Orange County, California. So I'm in San Clemente, South Orange County. I live here with my wife and my son and daughter. And so we've lived here for most of my life. But I own rental properties that are managed by Marshall Reddick in San Antonio and in Austin. And I just absolutely love those markets. I've done very, very well in those properties. And I've been a real estate investor actually since I was 19. So I started with the company in end of 2004. I got a job as director of marketing for one of the lenders at the time. The next, probably halfway through the next year, I'd gotten very ambitious. I got a real estate license right away. I'd been interning actually while I was going to college, and I ended up working for one of the lenders, and I just never turned back. So I've literally been a lender ever since. This is all I've really ever done except for meat department supervisor at Albertsons, and then working with my dad when he had a yacht brokerage in Lido Island. When I was growing up, I worked with him for a couple of years. But other than that, that's all I've ever done. So I have a big, huge passion for it, and you guys will hear some of that tonight in just how I speak and the things I'm going to be going over. A couple other things is that my company's licensed in all 50 states. We have brick and mortar in all 50 states as well. So if you guys are looking to, it's been coming up a lot lately. People have been wanting to 1031 exchange properties out of markets that may not be as ideal. Maybe you bought the properties thinking it was going to be a good market, and then you happen to hold it. And through COVID, now they've actually gone up a lot, and now you can get out of those areas and maybe 1031 into a better market. Maybe the properties are getting old, and maybe you just want to try putting the money to work in a different market like Texas or Florida or Tennessee. So I have loan officers in every state, and those loan officers have realtors in every state. And so if you don't have a good agent in any of those markets, so you're trying to maybe sell some properties in 1031, we can help you get a good agent in any market in the U.S. Marshall Reddick already has referral relationships with most markets. So if they don't have one, we can help you get one as well. And then Rachel can help you with restructuring a portfolio. So we're doing that a lot right now just because property values are pretty propped up in pretty much every area in the United States. definitely come down a little bit in some markets, but again, they're just much higher than we saw the market in like 2018, 19, 2020. Okay. So a little bit about CMG, again, licensed in all 50 states. We're a loan servicer, so your loan stays with us after you close. Most banks sell the loan on the secondary market, and then your servicing transfers, and you have to set up your payments again with a different bank. We reserve the right to do that, but our servicing book is building. I think we've got a $60 billion portfolio. We're not looking to sell any of our loans right now. We're looking to hold on to them, and then we're planning on doing a refinance with any time in the future when the rates come down where it's advantageous. We actually have an incentive plan, and we're offering a no lender fee refinance for all clients that close in 2022 through August of 2023. So again, we don't want to lose your business, especially not for the refinance in the future. So just keep that in mind. If you bought a property with me last year, that will stand up. It'll be no lender fees, and anybody that's buying through August of this year, you'll have the same plan. And you know, I think if inflation just really doesn't come down below 4% by around August timeframe, we'll probably push this out through sometime in 2024. So again, for right now, though, this is good through August of this year. We've got special investment property financing. So my company also owns a broker dealer. So we have the ability to fund our own loans and then sell those loans to our own broker dealer, securitize the loans, and then service them. So I've been able to put together some amazing interest rates for 30-year fixed and for 7-year fixed ARM financing, and I'm going to talk about that later on tonight. And then we're the 10th largest bank in the nation. So you obviously, you know, you get big bank rates, but you get the Reed Hazard team service. So I'm a branch within CMG, and me and my partner are two of their top funders nationwide. So again, you know, we have kind of our own bank within a bank, but we're a massive company. So you get all the best benefits like loan servicing and special products and, you know, ability to log into an online account, make your payments, you know, and set up auto pay and all that good stuff like you would at a normal bank. Sorry, this is a little slow tonight.
So weird here. I might have to hop out and make it. Says I've shared control. Sorry.
It's okay.
Oh, there we go.
Okay. So information I'm going to be covering: getting pre-approved, the best loan programs available for primary residence and investment property financing. Also going to cover how we're getting creative in this current market. I'm going to go over some of the private financing options offered through Marshall Reddick, and then I'm going to give you guys a market update. So getting pre-approved, obviously very, very important to do this if you're serious about placing offers right away. If you're looking at building a game plan and you just want to see if you qualify and just, you know, kind of run some numbers together and get pre-qualified, but you might not be buying in 6 months or even 12 months, I'm happy to do some mortgage planning with you. And you'd want to start off with Rachel, and you guys discuss your goals, and then she'll introduce you over to me, and we can talk about the financing. If you're looking to buy a property in the next 90 days or even 120 days, it's definitely a good idea to do a full pre-approval. It'll show you what you qualify for. We can go over exact interest rates based on what you qualify for, and then you can place an offer right away. So if you find the right property on a Saturday or Sunday, you don't have to wait, and we can close the deal that's fully underwritten up front in about 21 days, sometimes 18 or even 15 days, but the market doesn't really need that. I think 21 days, you look just awesome. And sometimes sellers want a 30-day escrow. So it just depends anyways. But by getting underwritten up front, again, just really puts you in the driver's seat to be as good as really as an all cash offer. Sometimes finance offers are better than all cash. What if the bank statements for the all cash offer are, you know, from a different country and you can't get the, you know, the buyer on the phone? There's all cash is not always king in real estate. A really great offer with a good down payment and a solid approval letter can be just as good. And then organizing your plan, obviously, education for buying your first home or rental property, lending education to help you build a rental portfolio over time, and then preparing yourself maybe for an upcoming 1031 exchange. These are all services that Marshall Reddick offers. That's why we have Rachel, who's a real estate advisor. And that's why their lender, who's myself, is skilled in rental properties, is because so many of our buyers are doing very intricate things. And so we try to make those intricate details a little bit easier. So that's the other reason why you want to get pre-approved, especially if you're going to plan a 1031 exchange. You want to know that you're qualified ahead of time. And even if you know that you're qualified, you want to at least get prepared ahead of time. And again, we want to run those numbers for you so you can see how much property that you can exchange into with the amount of money that you're going to expect from your sales. Getting pre-approved, we just have you go to my website, reedhazard.com. You'll click on the Apply Now tab, and then you'll upload your documents at the end of the application. And then my production manager, Mike, will reach out with any questions after we get your application and documents. We then run your loan for the AUS approval. In some cases, we'll do like 100% fully underwritten loan where we'll issue loan disclosures to be signed up front. In many cases, we don't really need to do that. This process right in front of you is usually good enough. But in some cases, we may even go a little bit further than this. This would represent a pre-approval, and we'll get you prepared to write a pennant offer to close within 30 days or less. My sales team, so some of the people that you would be talking to throughout the transaction, that's my partner, Al Rodriguez, right there to the right from the top. I'm going to have him start contacting some of my clients through Marshall Reddick. Al's fluent in Spanish. Al funds about $160 million a year in loans. He's fantastic. And he and I have been partners since I was 22 years old. So I'm 30, almost 37 now. So just very, very close man in my life, and love Al, and he does a great job for everybody. So you may or may not be speaking with Al here in the future. If you have any Spanish, or if you have the need for fluent Spanish, again, Al's fantastic. And then Mike Lynch down here on the bottom left. Mike's been doing loans for about 30 years. And Mike is my production manager. His job is to put together the file and to pre-underwrite the loan up front. And he works with my two main underwriters. And so he's really the puzzler. We have transactions in Marshall Reddick. We just had someone that sold a home in Burlingame, and they 1031'd about $2.5 million into 9 rental properties. And we did those all at the same time in multiple different markets. We did, I think, 4 in Florida, like 3 in Texas. He bought a condo in Santa Barbara, and we bought 1 property in Tennessee. So we were able to put those things together because of I'm not a one-man band. Like Mike and Dave. These puzzlers really helped me put together files that are very complex. So Mike's just fantastic, and he's a big part of my team. Jessica Yinger, she's my loan assistant. She handles a lot of the upfront, like ordering title and escrow, ordering the appraisals, client updates. She reaches out to go over your loan disclosures with you once those are sent. So really just a full service team. And then Leah's my processor. She's not on here, but Leah does reach out to my clients a lot, like the last half of the transaction. Rachel, did you touch that again?
All right, I keep trying to mute myself, and I think it's just messing with it. All right, let's try again.
Yeah, I got a lot to get through too, so this is gonna hold us up.
I won't touch it again. Sorry, guys.
No.
Here, I'm gonna exit out, and we'll just start it, and I won't touch my screen at all. Oh, goodness.
All right, we're gonna try this one more time. Do you mind just going to the next slide for me?
I'm trying to do that. It's not here. From current slide. Here we go. I'll just play presenter there. Sorry, guys.
Yeah, so anyways, just long story short, most banks, they don't do any of this. They just run an application and your credit, and then they give you a pre-qualification or a pre-approval letter. So definitely doing it the other way is how you get the most prepared, and that'll protect you as well. It's like insurance for your transaction. Some commonly asked questions: how long is it good for? 120 days. If you're not looking to buy for 4 to 6 months, like I explained, we can just have a consultation, and we can come back and run your credit when we get a little bit closer to closing, or rather to buying. And then the pre-approval takes about a day to get that done. And if you get us everything in the morning, we can even have it same day by like the evening time. Just depends on how complex that your file is. And what if I want to purchase more than one property? Again, we've done, I've done 9 at one time, never done 10, but I've done 9. And so again, very complex 1031s. We definitely want that business and can help you. And after you get pre-approved, just general info not to do is when you're we're going to be buying some properties, just try not to open any new credit. And if you have to, just contact me. If you're working with a different loan officer, just contact your loan officer, talk to them, let them know what you're doing. Try to stay at your current job while we're in the process. If you get a new W-2 job in the same line of work, you technically could go to that new job and we can make it all work. So communication is key. But if you can keep everything in the same place, that's really the best way to do it. Again, communication is key. And then staying current on all of your payments on everything. Just one late payment, can really hurt your credit. FICO scores have a lot to do with rate pricing, especially for investment properties. And so before I go into the loan programs, I always explain how debt to income ratio works. How do we qualify you for these loans? These loans that we're doing are being sold to Fannie Mae and Freddie Mac, or they're being transferred to FHA and VA, right? Like why are these guidelines put together? Well, it's to show that you have the ability to repay. And when the government basically had to purchase Fannie Mae and Freddie Mac and buy them out of their debacle they were in the 2009 and 10 financial crisis, they created guidelines and said that your debt to income ratio, no more than 45% of what you make can go out of your pocket every month. And so the debt to income ratio was 45% all the way till about 2016, when in 2016 we saw the employment market start to get a little bit better. We actually started to get some inflation again, and it appeared that we had recovered from that massive financial crisis that we had been in 2008, 9, 10, 11, and 12. So debt to income ratio is what all these loans are built off of. You want to get the lowest interest rates, with the lowest down payment requirements for buying a primary home or an investment property, you have to qualify with the debt to income ratio. So we all have a debt to income ratio. A simple calculation is if you make $10,000 a month in income, let's say your W-2 $10,000 a month, and let's say that you own your home and your monthly payment on your home with principal and interest on your loan, property taxes, homeowners insurance. Let's say you have an HOA. Let's say that whole payment is $4,500 a month. $4,500 divided into 10,000 would be a 45% debt to income ratio. And then any other items that are on your credit, minimum payments on auto loan or on credit cards, any auto loans, installment loans on your credit, you'd add up those minimum monthly payments. You add that with your home expenses, and you divide that into your monthly income. And that will give you your debt to income ratio. We don't include cell phones or utilities or health insurance. We don't include loans to family and friends. If it's a business loan and we can show that it's filed under your business, even if it's personally guaranteed, but we can show that it's used for the business, we can sometimes omit that type of debt. But again, that's how we calculate debt to income ratio. And most loans, you can qualify with a max debt to income ratio now of 49.99%. As you can see on the screen, FICO score has a lot to do with how high that you can go in debt to income ratio. If you have better credit, then you can go to a higher debt to income ratio. If your credit's not as good, then you're going to get capped usually a little bit lower on your debt to income ratio. Now, one thing that I do want to cover on debt to income ratio, let's say, Reed, my debt to income ratio is 46% right now, but I have good credit and I've got, $100,000 and I want to go buy an investment property in San Antonio, and it's going to be $300,000 and I want to put 20% down. So I'm going to need like $70,000 with closing costs. Like, I'm ready to go, but I already have a 47% debt ratio. Well, when you buy an investment property, the government, Fannie Mae, Freddie Mac knows that you're going to rent it out. That's why interest rates are higher on investment property versus primary residences. We know that you're going to rent it. It's also why you have to put more money down on an investment property. is because it's an investment property. But the government will allow you to use 75% of whatever the rents are going to be on that property, and they add that onto your income towards qualifying. So let's say it's going to rent for $1,000 a month. Well, $750 of that we can add onto your income towards qualifying. And so for most properties from a debt to income ratio standpoint, pretty much pay for themselves. So you can already have a higher debt to income ratio and you can still go out and buy rental properties right away. The first program that I'm going to cover is conventional Fannie Mae, Freddie Mac financing, right? So where the loans are underwritten under Fannie Mae and Freddie Mac guidelines with the ability to be purchased by Fannie Mae and Freddie Mac. Many other institutions and hedge funds and foreign central banks purchase Fannie Mae mortgage-backed securities. So mortgage bonds, a pool of mortgages, $5 million of mortgages, right, put together into a bond, securitized and sold to other institutional investors. So these loans don't all go to Fannie Mae and Freddie Mac, but they're underwritten with the ability to be sent there. And this is what most of the United States is financed on, especially when rates came down like they did the past couple of years, when rates were in the mid to high twos. You know, everybody was refinancing and onto conventional mortgages. So most of the United States, why I'm going to talk more about this tonight than anything, is it has the most ability to move the market. The guidelines with Fannie Mae and Freddie Mac move the market. Fannie Mae and Freddie Mac raising their loan limits increases the ability to have appreciation because now more people can now buy with a higher price. There's more liquidity at a higher price. Okay, and this type of financing only requires 3% down for a primary residence and 5% down for a primary residence when you go to a high balance loan limit. $726,000 is the max loan limit for Fannie Mae in most of the United States. But in what's called a high cost market like Orange County or Los Angeles, you now can go to $1,089,000 loan amount with as little as 5% down. So as Fannie Mae loan limits go up, we've tended to see appreciation stick more. And I'm going to show a graph a little later on that. It's pretty fascinating. 30-year fixed and adjustable rate mortgages with no prepayment penalties. There's no prepayment penalties on these types of loans. And the lowest rates for higher credit tier borrowers. Minimum down payment options available for primary residents, low mortgage insurance costs. So when you put less than 20% down, you have what's called monthly mortgage insurance. You can buy out your mortgage insurance at closing of your purchase, but it's very expensive to do that. And a lot of times it makes more sense to just pay it monthly and then refinance off the mortgage insurance later as your principal balance has gone down as you've made payments. Maybe we get some home appreciation and eventually you can refinance and just take off your mortgage insurance. If you believe rates will be lower in 3 or 4 or 5 years, if you were to buy a home now and do 5% down, you would just pay monthly mortgage insurance. And then again, here in the future, we could refinance, take off the MI, and maybe lower the interest rate quite a bit. This type of financing allows you to buy up to 10 financed properties. So anything over 10 financed properties, private financing will then be the best option. Now, I wanted to show the comparison with loan limits from 2022 versus 2023. So we saw about almost a full 12% increase in the Fannie Mae loan limits from 2022 to 2023. You also saw in 2022 over here on the right-hand side, you'll see it was $970 was the max loan limit with 5% down. In my local market in Orange County, you're noticing that homes up in that lower million range, higher, 8 to 900 range. There's still very, very, very high demand for those properties. And again, it's because Fannie Mae financing now allows you to go all the way to, as you can see here, $1,089,000. Also want to point out anybody looking maybe to buy a duplex or 1031 exchange into, maybe you want to sell some out-of-state properties and buy a duplex in, Dana Point or Capo Beach. You can now go, if you see here, you can go to $1,394,000 loan amount for a 2-unit. That loan requires 25% down. You can do a 4-unit. Look at that, $2,095,000. I remember when that was like, for like ever, it was $801,000 was the max loan limit for a 4-unit. And then around, I think it was like 2016, you started to see that go up, and it went up to like, I think about $1 million by 2021. And it's just continued to go up more and more and more. And now again, you can see the standard loan limit, like in Texas, for example, you could do a 4-unit loan amount of $1,396,000. You can go buy a 4-plex in Austin, put 25% down, get Fannie Mae financing for $1,396,000. You could buy a local property here in Orange County. You could buy a 4-unit that requires 25% down, and you could get $2,095,000 of loan amount. The 7-year ARM is a much better rate for this program, but 30-year fixed and 7-year ARM. The 30 year is palatable. You can get some seller credit to help you buy down your interest rate. You can really make those numbers look very attractive. So here's the Fannie Mae loan limits, the history of Fannie Mae loan limits. There's such a good graph that shows it like all the way back to like 1980. But if you guys, there's a website called hsh.com. If you ever want to go on there and look at it, you can see the history of Fannie Mae loan limits, and you can even study recessions, and you can study what did Fannie Mae do. And they weren't government owned then, but they were the biggest purchaser of mortgage-backed securities on the secondary market, and they created liquidity for lenders to operate. So they had a lot to do with home price appreciation. And you'll notice the only year that they ever lowered Fannie Mae loan limits was in 1989 to 1990. Okay, they lowered loan limits from 187,600 to 187,450. They lowered the loan limit $150. There was a recession going on in that time. You had a recession in the early 80s because the Volcker Act and rates going to 20%. As rates came down, you had a big boom because the economy was very strong. And that boom lasted all the way till like 1989, 1990. And in 1990, there was a recession because of dampened consumer confidence. People that had taken out loans from the early 80s through 1990 were sitting on very high interest rates, and that debt began to catch up to them. The rates in the early 80s through 1990 were 18% for a 30-year fixed mortgage, and they probably went to around, I'd say 9 or maybe 9.5 or 10% as an average by 1990. And so those high rates really just depressed the market, where for a while they didn't, but eventually it caught up to the market, and we had this recession that went from around 1990, 1991. And again, even then, they only cut it by $150. Then in 1991, they started to raise it again. By 1993, they had risen it from 187,000 to about, I'm actually looking at it right now, they raised it to 202,000. So the Fannie Mae loan limit, even through, as you can see right here, 2006, 7, 8, 9, 10, even through that just disaster, wages were still strong enough for people to justify a 417 average loan amount with Fannie Mae. Then in 2016, we started to get some wage inflation back into the market. Jobs market started to do a lot better. I think unemployment was about 5% at the time, and they started to raise the Fannie Mae loan limit again. And then in 2017, we got tax reform, which caused a ton of wage inflation. And as a result, you saw Fannie Mae and Freddie Mac start to actually raise their loan limit. The Fed hiked interest rates all of 2018, which caused 30-year rates to go to about from 3.875 to 5.25. And as you can still see, the jobs market, as it got stronger, demanded higher prices for real estate. And you saw the Fannie Mae loan limit continue to go up until you can see we had a huge leap in 2021 to 2022, and then again a huge leap from 2022 to 2023. I'll be really interested to see what it looks like this next year, if they keep it flat or if they still continue to raise it. We are in a very strong jobs market. So once we're out of these Fed hikes, the economy will probably be in a perfect position to start growing again at a normal pace. And then they'll probably just keep raising this loan limit a little bit each year to help with just the cost of living and inflation in general once they've got wages back at about a 2% growth rate. So if interest rates right now are too high, well, that's not true. There is tons of different options right now to keep rates low. Consumer confidence is not as good right now. We're all waiting to see what the Fed does and the economy does. That uncertainty is creating opportunities. It's very hard to time the real estate market. I always say, I buy another property when I can at least put 25% down. And for me personally, I like to have 12 months of cash reserves for all of my properties. At that point, I'm comfortable buying another property, and I'll just find a good market and I'll put enough down to get it to break even. And that's just how I buy real estate. But the point is, timing it is very tough. So you buy when you're ready. Timing the market is just, again, it's very tough. So if the rate really matters to you a lot, this is an example of what's called a temporary buy down. This is actually a 3-1 buy down. I have a typo here on the page. It's supposed to say 3-1 on top. What this allows you to do, you can pay 2% of your loan amount at closing, okay? And you can start off your interest rate 3% lower the first year, then 2% lower, then 1% lower. Then it adjusts your actual rate on the fourth year. If you refinance any time in between these payment cycles, any amount that you've paid in your buy down, this is an example, by the way, the buy down is higher for a 3-1. But any amount you pay at closing for this goes into an escrow account. Okay, just like your taxes and your insurance do if you're paid those with your mortgage payment each month. They go into like a savings account held with the lender pays them for you when they're due. Same thing with this. And if you refinance before that third year is over, any amount in that account that's left over goes right back to you. So if you can get a seller to credit it, then essentially they're just paying for you to have a lower payment for the first few years. If you're, you want to make sure your fixed expenses are in a certain position, it's a great option to maybe take some money out of savings and do this buy down program for peace of mind. And then again, if you refinance out of this, you just get the money back that you had to essentially put into escrow as a buy down fee at closing. This is a great program. Another program that we have right now is our 7-year ARM. And before I go into the all-in-one, I want to talk about that. The 7-year ARM that we have for investment properties, we have quite a few communities where the seller is paying 2% of the sales price in seller credit. On an investment property transaction, the max credit a seller can give a buyer on an investment property transaction is 2% of the sales price. With that 2%, we can use that. And right now with rates going up like they have the last week, if you pay about 1.75, maybe 2 points out of your pocket, with that seller paying the rest, you can get a 4.75% duplex investment property rate with only 25% down. It's fixed for 7 years. It's held by my company, and we will refinance that loan when rates come down in the future. I'm also going to show how interest rates do follow inflation here in a minute. So we do know at some point that they will, ease up a bit. And so the idea here is if you're very rate sensitive, the 7-year is a great product. I don't really like pushing adjustable rate mortgages. I just have never liked them at all. All of my properties are on 30-year fixed. If I'm buying in this market though, and it's a 7-year fixed loan, and I already can see the outlook on inflation, and we can see that these different charts that even show as inflation cools, 30-year rates get better, and I want to have better cash flow at the start, a 4.75% interest rate you won't find it anywhere online for an investment property. You probably won't even find it for a primary residence. For primary residence today, a 4.75 on that same exact loan would have no points. So that 7-year loan it really is a fantastic product. If you're self-employed or if your income, let's say that you're self-employed and you have really good years and sometimes you have really bad years, some peaks and valleys. I'm in the mortgage industry, so I can tell you there are lots of ups and downs. For things for buyers in those positions, even if the rate looks pretty on a 7-year, I would always say just go with the 30-year fix. Same scenario with seller credit, can do about a 5.875%, maybe a 5.75% today for a 30-year fix on a duplex or a single family home with only 25% down. So not much higher in rate. The cash flow will be not as good, but it's a safer loan. So those two options, again, I'm doing the most of right now. And it's just phenomenal to see anything with a 4 in front of it. You guys will notice that the cash flow really does look a lot better. Now, I want to talk very quick about the all-in-one loan. This loan was created by the owner of my company, Chris George. And Chris George was the chairman of the Mortgage Bankers Association for 2 years. He sat in Washington. He's just a really fascinating guy. He loves his company. He is a single owner of CMG. And again, we funded $30 billion last year. So this is a man that does not need to work anymore at all. It doesn't matter. He just loves what he does. He loves his originators. He loves his support staff. Just a great owner. And he created this program. If you want to know more about how it works, it's a first lien position home equity line of credit. The rates are really high right now on equity lines. So the rate's high on this product. And I think that as the rates go down in the future, as the Fed ends up cutting rates eventually, that this will be a little bit more of an attractive program. It can still make sense for you if it's a primary residence. And if you don't have a loan on your property currently, it can make a ton of sense. But again, if you want to know more about this, just Google all-in-one loan. It'll teach you all about it online, and then we can have a consultation to discuss it if you guys are interested. VA loans. I live right by Camp Pendleton and have for most of my life. So we love our vets. We take amazing care of our vets. I think CMG is the number 3 VA lender in the whole nation. We have no loan cap on our VA loans, so we're one of the few lenders that you can literally buy 100% financing on a VA loan with an unlimited loan amount. True story, I've done a $5 million VA loan in Newport. It was a colonel out of Coronado Island. He put 0 down on this loan. He got a 2.25%. This is the best loan I've ever done. 2.25% interest rate, no mortgage insurance, no VA funding fee. He had gotten injured and he ended up recovering, but he ended up getting a VA disability where he was able to pay no funding fee. So no point, 2.25%, no mortgage insurance, 100% financing, $5 million loan amount. So again, if you're a vet, you have very high income, just ask me about the VA loan. FHA financing, this is a great product for a few reasons. If your credit is in the process of recovering, maybe you had a short sale or a foreclosure 3 or 4 or 5 years ago, maybe you had some rough credit issues, a long time ago, and your credit scores are not that high still yet, but you're making great money and you've got some savings. You can buy with as little as 3.5% down. The interest rates are really good. And this is like the next best product after a conventional loan. It's also great even if you have awesome credit, if you want to buy a duplex to live in one side and rent out the other. Because you can buy a duplex with only 3.5% down with this loan product. So for a lot of buyers, and I'm doing this all over Texas right now. I do some of it in California. I've got one in escrow in LA doing this right now. So that's a really, really great product if you want to buy a 2-unit and you don't have enough down to do a conventional loan. Conventional loans require 25% down for a duplex on an investment, and they require 15% down if it's a primary residence. So you go from 15% down to being able to put 3.5% down. So that's a great, great product, and I'm using that a lot right now. The loan limit also on that in Los Angeles goes all the way up to $1,356,000. So you can do 3.5% down to $1,350,000-ish loan amount. So just a great product. And the FICO score requirement is 580 plus for your middle credit score between the 3. Jumbo financing is any loan above $1,089,000. So it also can be any loan amount above $726,000. Especially like in Texas, if you're going to buy a home and maybe you're going to buy a primary residence and it's really expensive, you can do a jumbo loan there and go all the way to a $3 million loan amount. Here in California, the jumbo is you can do loans probably to $10 million. But the most commonly used jumbo loan for a larger purchase price is around a $3 million jumbo loan or below. 680 credit score required. If your FICO, this is a very FICO score sensitive product. The higher the credit, the better the interest rate. The lower the credit, it really hurts the rate a lot.
And you can do a debt to income ratio of actually 45% on this. Most banks are capped at 43. As you go higher in loan amount, you do need to be at 43. It actually is a $3 million 45 DTI though now. So again, 45 debt ratio, it's always been 43. So we've seen that loosen up a little bit the last 2-3 years as the jobs market's just gotten better and better. Self-employed borrowers are okay. And the standard has always been 20% down. You can do this product with as little as 15% down. Some banks still do 10. But really, you're going to be the happiest with the numbers with 20% down as kind of a minimum. And then ARM financing is available on these as well. When I say ARM, I mean adjustable rate mortgages. So loans that are fixed for 5 years or 7 years or 10 years. And those tend to carry a little bit lower interest rate than your 30-year fixed. The 7-year that I've been talking about that has an insanely low rate, that's for conventional loan amount. So any loan amount below $726,000 for a 1-unit property nationwide. And for a 2-unit, it's a 2, 3, and 4 unit goes to about $1 million loan amount. So the ARMs that I just discussed on this page, they're for loan amounts above that. And that's me doing this at American Direct Mortgage, the first mortgage company that I ever worked for with Marshall Reddick. When I was literally, I think I was like 20, maybe 20 or 21 in that picture. Very intense. Loving what I do. Back when we all used to wear ties religiously, I love ties. I feel like I don't wear them anymore, but I'm going to start wearing a tie again sometime. It's fun. Okay, down payment requirements for investment properties. 15% down is actually the minimum down payment for an investment property, not 20% and not 25%. But you get a much better rate when you put 25% down. That's the sweet spot. And in most banks, you get a better rate on a 2 to 4 unit property or even a 1 unit with 30% down. We don't have that overlay because we securitize our loans. So we don't care if it's 25% or 30%. You're still going to get that best rate. So you only got to put 25% down. If you want to do more down, that's great. That's because you just want to have a lower monthly payment with better cash flow, though. You don't have to do it for the interest rate. And again, I know I already mentioned it, 2 to 4 unit investment properties require 25% down as a minimum. 1 unit properties, you can go as little as 15% down. And then some things you need to know to get 10 finance properties, just maintain your credit scores above 720. And you have to have 6 months of monthly payments in reserve. So principal, interest, tax, and insurance, and any HOA on any of your properties, a monthly amount for each property. You can have 6 months of that, and that's your reserve requirements. Max debt to income ratio. Once you go above like 7 finance properties, they usually want to see the ratio at 45%. And this is for 1 to 4 unit properties only. You can have multiple loans, but you can only have 10 finance properties. So meaning you could have first loans and you could have home equity lines tied to rental properties. It's not going to count as one of your 10 loans. It's individual financed properties, not the amount of loans you have tied to each property. Also, if you, let's say you bought 10 investment properties. I've had a couple clients come to me that have 10 investment properties and they don't own their primary residence. And now they want to buy their primary residence. We can use a loan, a Fannie Mae loan, no problem. So you can have 10 investment properties and buy your 11th property as a primary residence. But if you have 9 investment properties and 1 primary residence, that's your 10 finance properties. And this is for the 15-year fixed, 30-year fixed, 7-year ARM. We also have a really good 10-year ARM. We can discuss any of those products. And then again, I already covered this, that you can use the 75% of the projected rental income on any home that you buy as an investment property and add that onto your income towards qualifying. So if your debt to income ratios are already on the higher side, you're going to be fine. But again, that's why we get you pre-approved. So if you can't qualify for conventional financing, or if you're looking to do a renovation loan, or if you need a bridge loan, or if you're trying to buy a property out of your self-directed retirement account, it's a great way to do it. Maybe you have $150,000 at a prior employer. It's sitting in a 401k. You can roll that money into a self-directed IRA account with a bank called Forge Trust. You can roll it in there. You then can go and buy a property with that IRA, and you can get a loan against it It's a private money loan, right? You could do a 30-year fixed loan right here. It's 6.5. Excuse me. You could do where's their 30-year on here? I know it's next page. It's not on here, but it is on their website. If you go to marshareddick.com, click on the borrow tab, you can see all of their different rate sheets and loan programs. But again, you can buy a property with a self-directed retirement account. You can buy in an LLC. They offer renovation financing. And these guys have got like the best rates, fastest service. So again, if you can't qualify with my type of financing, they also have great long-term fixed products. The rates are a little bit higher, but if you put 30 or 40% down just to buy an old property, again, it's great financing. And all the products are right there on the website. Okay, so we're going to move into the last segment of the presentation. We're running a little bit behind because of these slides taking a while, and I really do apologize. So if anybody does have to go early, totally understand. If you can wait, though, to listen to the last part of the presentation, definitely do. So in this slide, and really moving forward, I'm going to do more of a market update, and I'm going to kind of go into like how I'm seeing things and where I think that we're going to land here for the year. I'm going to try to put a projection out there as best as I can. So that's pretty much what I'm going to go over here for about the last 20 minutes. So this first slide is I want to show why rates are so important. Like, why do we always talk about interest rates? Like, every 1% rise in rate is a 12% increase in your monthly payment. When you buy property, cash flow is the glue that holds it together. When you go on the Marsha Reddick website, or you could even Google Marsha Reddick calculator, and look at their calculator and put in a property and then go do all the math, or even go to their website, go to the properties tab, click on investments, properties, look at a property and scroll down to the investment calculator. They have a calculator for every property on there. And at the very bottom, based on years held, 15 years hold is how we normally put together all of our properties. That's the average turn time that an investor holds their property. When you look at the 15-year period and you look at the accumulated cash flow, even on a property that cash flows from day one, after maintenance and vacancy over time, you realize that cash flow, that income coming in on that property was just the glue that held it together so that you could experience two things: principal buy down, your mortgage payment going down over time as payments are made, and appreciation, right? Buying the right property class maybe to get more appreciation. So when we look at cash flow is extremely important. It's not what gets us rich. Maybe after you have a big portfolio or a portfolio that's worth a lot of money, you've had it a long time, and you don't need appreciation anymore. You don't need the home value to go up at all. You just need cash flow to replace your income. Then you care more about cash flow, where that is your supplement to live off of. So you might want to exchange your properties into more of a cash flow investment, homes that might just have more cash flow. But while you're building that wealth, you realize the cash flow is just the glue that holds it together. And so again, when we come back to interest rates, why they're so important is every 1% rise in rate is a 12% increase in your monthly payment. And that's going to dilute, that is going to erode at your cash flow. Average rate since 1971 is 7.75%. The average rate since the 30-year fix has been around, it's been about, I think, like 6 5/8. But I'm going to use this off of just like 1971 because by 1971, World War II was pretty far behind us. The Fed had interest rates at zero for over a decade, and there had been a lot of economic growth. And not that we had forgotten about World War II, but we were definitely past it at that point. And so since the economy was back to more of a normal level, and again, that was an oil-based economy, like it was a totally different world than where we're at today. But that's, again, I want to use 71 as our starting point. So the average rate's been 7.75%. Now, what have rates done since the Fed started hiking? This is a chart of January 2022 through today. And I've highlighted 2 points. We started 2022 at a 3% interest rate. We topped out a little bit over 7%. That's the highest that the 30-year fix got. And then now today we're at about a 6.38 or so percent interest rate. This is what rates have done since 2023. So we started at 6.45%, and we ended up going down a little bit. It was looking great and rosy. because inflation has literally been coming down. CPI inflation, consumer price inflation was actually coming down for 3 months, where we were at a neutral, a zero, or we were at a negative number even over months. So things were really cooling down. And then why did we start to go up here at just the very beginning of February? Hot jobs numbers. We're seeing higher than expected consumer price inflation. We're now seeing higher than expected producer price inflation. And I'm going to break that down for you guys today, and I'm going to show you what's going to happen with rates as the market cools itself through all of these rate hikes. What are rates going to do, and what have they done in the past when we've gone through this? So this is interest rates from 1971, okay, April, till today, okay? Interest rates, 7.5% I've highlighted because that's about, we got to about 7.3% through these rate hikes back around October of last year, and then rates started to ease from there because we got a surprise CPI report. I'm going to cover that on my next chart. But what I want to show just a couple things here right now. If you look at this top right here that has that first red line, this guy right here, okay? Whenever you get to a top, then you have something that's called a double top. When you get to a top like this, okay, something happens and you start to see that the momentum of this going up starts to lose steam. Where it lost steam is when the Fed stopped hiking interest rates, okay? And then it continued to lose steam. We saw a double top, and over time as inflation cooled, inflation really came down and 30-year fix came down with it. We're seeing the same type of trend. Interest rates, so in the early 80s, Paul Volcker hiked interest rates to 22% on the federal fund rate. Through the late 70s, we were at max output for oil. We had pumped everywhere that you could drill for oil had already been drilled. And back then, oil ran the whole world. There was no other alternative energy source. So as we got into an oil shortage issue, and then we had the Yom Kippur War and OPEC shut off oil to the rest of the world, oil prices flew up well over $100 a barrel, and we had extremely high inflation. And Paul Volcker had to raise interest rates on the Fed fund, which today is 4.5%. They had to raise them all the way above 20%. And as a result, we saw inflation come down, and then it started to whipsaw, right? They had to raise it even a little bit more. But when we got to the end of their tightening cycle where they were almost there, they weren't quite there, okay, is when this peaked and you started to see inflation cool because of those rate hikes working. And then as those rate hikes ease, you started to see 30-year fixed mortgage rates come down. It's very possible that last year was that year. We're not positive yet, but it certainly does look like that on the back end market. I'm going to cover that a little bit more here. Why I show you this slide is that over time, as inflation cools, 30-year rates are definitely going to come back down. So it's about finding a good deal, and then you can always refinance in the future. Here is a chart that shows 30-year fixed mortgage rates and inflation and how they track one another. 30-year fixed rates are a little bit behind inflation always. So they're always trailing inflation a little bit. You can see here all the way over here to January 20. No, this is actually January 22, but you can see that CPI inflation and core PCE and everything was just going absolutely berserk here. And then as a result, look at what happened to mortgage rates, right? Bam. Followed the exact same thing as inflation, right? So inflation ticks up a lot. Bam. 30-year fixed mortgage rates go up. Fed comes in to fight inflation by hiking interest rates. And then they start to dump all their treasury notes and some of their mortgage-backed security holdings. And they basically take all the liquidity away from what's keeping rates low, all this quantitative easing that they've been doing forever. And so it was really a Fed-induced push-up of the 30-year fixed mortgage rate. But again, all this is tracking itself. And we can see here, right here, that when inflation was at its worst in the recent past, from there as it started to come down, 30-year rates came down. Now I'm going to show you the proof. This is the Fannie Mae 30-year fixed mortgage-backed security. So when I was talking about these loans that we're doing, conventional loans, let's say we do $5 million of these conventional loans. They're bundled together and packaged. They are sold as a security on the secondary market, okay? And they're bought and sold just like the stock market. On this chart you're seeing in front of you, every day, every one of these candlesticks is 1 day of trading, Monday through Friday. A red day is investors selling the bond, causing it to depreciate, driving up the yield. Rates are getting worse when this thing goes down. When it goes up, on the green days, is investors buying the bond, causing it to appreciate, and that drives down the yield. So rates actually get better. So a good way to think of this is when we're way up here, this was in November of 2021 when the Fed said that they are now believing that inflation is no longer transitory, meaning it's no longer just because of printing all this money and, it's going to abate and it's going to come back down. No, it started to look like it's entrenched and it's here to stay. And you can see, so this is back when rates were about 2.99, 2.875 still on a 30-year fix. Then we come down here, right? And it's looking like right about here, things are good. This is back when rates went to about, give or take about 4.25. And man, we didn't sit there long. Russia-Ukraine war, just terrible what's going on over there. I mean, come on, you guys, like, is this the 21st century? Like, I feel like I'm taking crazy pills. But again, look what it did. Double punch to the Fed. Fed's already dealing with big supply chain issues. China still locked down due to COVID. China's been locked down, and even right now, they're still opening up, right? They're already dealing with big-time supply chain issues and the fact that they printed almost the entire deficit through lending facilities and gave that money to the economy to get through COVID, but didn't double the amount of supply. They didn't double the amount of housing. They didn't double the amount of toothbrushes or goods. So we were already dealing with extreme supply issues and supply and demand being so unbalanced. And now here goes Russia and Ukraine, and Russia invades Ukraine. And Russia, has a lot to do with oil. And Europe was pretty much living off of Russian oil. And so when that happened, it caused oil prices to just shoot to about $130 a barrel short term. We still live in an oil-based economy, not like in in the 1970s, but oil still filters into almost everything that we make. So when oil prices go up, it affects the cost to produce. When the cost to produce goes up, big companies pass those costs on to the consumer, and we get high consumer price inflation. So when oil that goes into everything still today, even your vitamins, to make vitamins, to run machines, everything is oil is in like almost everything still. So when oil prices go up like that, when they'd already been really high, they were negative 40 a barrel during COVID, and then what goes down always goes back up if there's demand behind it. And again, now they shot up to 130 a barrel. So we dealt with that for the next couple months as those oil prices set into the market. The cost at the pump in California in some places went to over $7 a barrel. The cost to transport goods, those high prices that everybody was having to pay, that profit filtered into core growth, right? And core growth for inflation went up dramatically as a result. So as you can see here, rates just tumbled quick. And right about here, we thought that we peaked. We thought that we were done. And we thought that, wage inflation was going to start to really even itself out, and interest rates improved a little bit in like July. And then we quickly realized that was just not the case, and the market had to double peak. And so we had a double peak in inflation back around, this is like October of last year. And then right here, Scott Pastel and I, the vice president of Marshall Redick, were up in the Bay Area doing a seminar. And that Thursday, actually, this is the CPI report that surprised everybody. And it showed that we had a double peak right here, and that consumer inflation was really starting to come down. Started to see wage inflation come down. We started to see personal consumption expenditures. Manufacturing sector by this point is looking really contractionary. Like, we just needed to kind of see these numbers, though, so that all the other anti-inflationary stuff that we were seeing happen could make more sense, and mortgage rates rallied. And then we saw them improve. Right here, we improved above this purple line. This purple line is our 200-day moving average, the average where rates have been over the past 200 days. We tried to stick above it. Then what happened? January, right? Markets opened up. Everybody got back to it. People started spending more money again, and people started taking more jobs. There's 11 million unfilled skilled labor jobs right now, and we have the lowest unemployment rate on record. That means that there are too many available jobs for the amount of people to work those jobs. That is causing very high wage inflation. Now, the Fed has been hiking interest rates to get employers to stop growing, to stop hiring, right? But the problem is 70% of the United States is a service-based job, and these jobs are needed. We have new border laws that are keeping some of these people from coming into the country. They were working those jobs before. We have 3 million people that retired after COVID and never went back to work. We have an issue with employment that I don't believe that the Fed can necessarily solve by hiking rates into oblivion. But the point is that when we saw that higher jobs number come in, and then that led into a higher services-based manufacturing sector, we saw that come in expansionary instead of contracting like it had been the prior 3 months. And then we saw consumer price inflation a couple days ago come in higher than expected. Today now we saw producer prices come in, showing that producer prices are still growing at about 0.5% a month, a 6% annual growth. We were at 11%, so now we're down to 6%. That's what's important. We are going down. But my point of all this is inflation's not cooling fast enough, okay? And as a result, look at how now we can see this. Bond pricing, mortgage rates are worsening. That's why you're seeing that on the news. Or maybe you're not. Maybe they're still telling everybody rates are getting better to get you to call lenders. But the point is rates are not getting better right now. They are getting worse, but nowhere near as bad as they were right here. And with seller credits and with getting, creative, we can still keep rates low enough to where it makes sense to buy. The question is, how much lower are we going to go here? We're probably going to see a flare up for a month or two in inflation because the economy is coming out of a very dismal fourth quarter, and that's just expected. So the Fed's probably going to keep hiking a little bit more. I'm going to cover that now. And then again, depending on what the economic data looks like, I mean, they could hike quite a bit more. So I'm gonna talk about that here. What caused rates to go up again? So why did they go up so fast, right? Inflation caused by Russia's invasion of Ukraine. The Fed no longer purchasing mortgage-backed securities. The Fed has been trimming their balance sheet, meaning they've been selling their treasury note holdings to the market, causing more supply versus demand. That's pushing yields up across the board. When the government issues 10-year treasury debt to the market, they are basically asking for the market to buy a loan for them. They're issuing their own money, right, to the market. And during COVID, they printed like somewhere around $9 trillion of money, and they printed their own money, debt into the market, and then bought that debt back. So they were holding most of it. So for them to push rates up on the 10-year and the 2-year debt and all that, the rest of the market doesn't have to sell that debt. The Fed can do it themselves. So they did it themselves. They've caused rates to go up by hiking interest rates and dumping their treasury holdings. They've now been buying some of that back, and you can see it in their balance sheet. And other foreign central banks and investors and large hedge funds have also been buying back the Fed's 10-year debt, even their 2-year debt. The 2-year debt's paying 4.5% right now. You can park your money. You can go buy $1 billion if you're a big wealthy man or a big wealthy woman or a big wealthy country. You can go and buy $1 billion that's backed by by the United States. You can buy our debt and hold it for 2 years and make a 4.5% return. The S&P 500, the 500 largest companies in an index within the stock market last year, best companies, that index went down 20% last year. But you can hold a 10-year treasury note right now, 10 years, and make 3.85% on it. So, even if the Fed keeps hiking interest rates, there's still going to be demand for treasury notes and mortgage-backed securities, and that demand is going to continue to keep rates from going up too much as we get to the end of our tightening cycle. It's really why I believe that we've already seen our peak, but it's going to be a long way, I think, probably even 12 more months before, you see inflation below 4%. And the Fed's target is 2%, as you can see here. The Fed's target is 2%. Currently, core inflation sits at 5.4. Personal consumption expenditures, which is the Fed's most closely watched target, stripping out food and energy, is going up about 4.4% a year right now. Still way too high. So we're going to talk now and go over that a little bit. Again, this is United States core inflation right now today. As you can see here, that was our first top. Here's our second. So basically had a double top. There's actually a term for this in the stock world or in the chart world, the securities world. So, I mean, I think with the data that we just got, we could see some retractment back up to here. If it comes in if wage inflation comes in extremely high again, and we start to see that number growing again, and it continues for the first quarter, then we could definitely see things turn around. But there's so many other readings on this, on the back end of things that show that year over year, it's factual. Inflation is cooling. So I'm not too worried again about us going back to those peak interest rates, even if the Fed has to hike a little bit more. Now I'm going to break it all down for you right here. What was the Fed fund rate before COVID? 2 to 2.25%. At 2 to 2.25%, the economy was doing great. Interest rates were about 3.625% for a 30-year fixed. When we get back to normalization, that's probably going to be your range. 3.875, maybe a 4% or a 4.25% on a 30-year fixed mortgage, and a Fed fund rate that's probably going to get cut down to around 2 to 2.25%. Before COVID, that was the interest rate where we had the best, growth that the Fed liked. It wasn't too fast, wasn't too slow. What is the Fed fund rate now? So again, before COVID, it was 2 to 2.25%. Right now, the Fed fund rate is 4.5 to 4.75%. Let's go back to my last slide. Where is core inflation? Core inflation right now is 5.6% is core inflation. Personal consumption expenditures is 4.4% right now, month over month. Year over year, it's a little bit higher, but month over month, the annual pace, actually, I'm looking at it right now, it's 4.4%. So either way, the Fed is going to they're going to go off of core. They want the Fed fund rate to be above core inflation. Now, if core inflation was coming down faster, okay, then they might still back off of more rate hikes, because we can see that the core number, even though it's well above 5 still, is coming down a lot faster. But after the readings that we just got this week, I would argue that they're going to keep looking at that core number and the PCE number that's still 4.4, a little bit lower than where the Fed fund's at now. But now with that core number over 5, no way they're going to hike us a little more. Again, as we get to the end of the tightening cycle, you'll see money move back into the longer end of the curve. That means the 30-year fixed rates will start to improve faster. That means that you'll see, your 7-year loans and your 10-year loans, the longer end of the curve will improve faster. Why? Because that money knows that by the time 7, 9, 10 years from now, with all these hikes that are going on and with inflation coming down, we can see that it's going to be a lot lower, and the Fed will actually have to cut rates. So that's why money flows into those, securities faster as we get to the end of the tightening cycle. The data that we got this week, again, we are not at the end. We will probably have to hike now over 5%. Market was already expecting about a 4.75% to 5%. And the Fed's been talking about having to hike Fed fund to 5.25% now for a while. So that's just going to get solidified, I think, now. But it's going to be data dependent. It's going to be very data dependent. And we're going to have to see how it shakes out over the next few months. If you continue seeing inflation, though, go up a little bit more the next month or two, don't let it frighten you too much. Just a better opportunity to maybe get a scared seller, or just get a better deal and try to negotiate maybe even a little bit harder. But just know that once the Fed pivots, my whole point here, once the Fed pivots, you're going to see interest rates, they're likely to come down a little bit faster from there. Now, is that at the end of this year? It could be. Is it beginning of next year? Is it mid-year? Probably not. But the minute that they pivot, they're going to do this softly. Because look what already happened in January when we had super low interest rates. Like, rates got a lot better again. Man, buying demand picked up, growth picked up. That's why we're going to get these flare-ups as we go back down. So try to pick a time that you can get a really good deal, and maybe a time also when we're getting that lower inflation data, and then you can lock in the best interest rate. It's very hard to time this stuff. And again, I don't advise doing that. Just get pre-approved and go out there and shop and see what's available. But again, like there's going to be different times throughout the year that we're probably going to have these like peaks and these valleys, and you're going to be able to see better rates. And then that's going to kind of come and go depending on the data. One thing that's for sure, the Fed is still watching what I'm going to talk about on my last section here. The Fed is watching the jobs market closer than anything. The Fed will not stop hiking, okay, until they want to see inflation down on the core. They need job openings to be more in line with the amount of available workers. Right now, there's 11 million unfilled jobs, right? There's a 3.5% unemployment rate. So they want to see that number closer to prior to COVID. Prior to COVID, there was 7.5 million unfilled jobs with a 3.7% unemployment rate. We have a lower unemployment rate today than prior to COVID, and we have 4 million more jobs available. That's the 3 million retirees, and the other million is probably some of the, we've seen some layoffs. We have seen some. We've seen a lot in the tech sector. Remember that the tech sector makes up 2% of the entire jobs market. Just because we've seen cuts there doesn't mean that the Fed's getting their way yet. So we're going to need to see the amount of job openings shrink. But one silver lining to this, if wage increases can continue falling, even with the tight labor market, like we've been seeing, we could see the Fed begin to look away from the labor shortage. They're realizing that there's more to this than just people not going back, than just companies having zero rates so long that they just created jobs for anything. Like, they can tell that, man, we really need all these jobs. I feel good having kids, that they're going to have the ability now to get an executive position or a high-level manager job, or, be a doctor, or be an attorney, or be a, anything. I mean, there was like not as many jobs available before COVID. Now with all the retirees, I mean, you've seen a lot of opportunity in our labor market. So the Fed is, I think, if wage inflation, which is currently hovering at about 3.6% annual, that might go up again a little bit, but if that goes up a lot, then we're going to have a real problem. But it's looking like that's trending down. For example, we hired 500,000 people. The market expected 180,000 hires. We hired 518,000 people in January. Okay, that is over 3 times more than we needed to. But the prices paid to hire, the wage inflation came in right at expectation. 0.3% month-over-month growth when we hired 3 times the amount of people. If that was during mid-last year, oh my gosh, that would have been the prices paid to bring on all those workers. We would have had a huge wage inflation reading, way higher. But this one came in right at expectation. So the market's moving in the right direction. It's going to take a while, and the news is going to scare people. That is their job too, But right now, we're still moving in the right pace. And I just hope that the Fed keeps a close eye on wages and on the market for jobs and realizes that we have a shortage here for fundamental reasons, right? Like, maybe we don't need to hike into oblivion just because there's still so many available jobs. So I do a market update every week. I'll put everybody on it that's on the call. If you guys don't want to be on it, then you can unsubscribe. But it goes out every Saturday. It's just weekly data. It's really, really good just to track. And it goes out every Saturday. Again, YCMG, we're licensed in all 50 states, brick and mortar in all 50 states. We're a loan servicer. We specialize in investment property financing. And we've got the lowest interest rates out there. This is mine and my partner's reviews. It's just our Zillow reviews, but we've got Testimonial Tree and tons of different online stuff. So if you guys want to know more about us, just go online and just read our reviews. And I'm going to hand it back on over to Rachel. Thank you again, you guys, for staying on the call. I know that we went a little bit longer than expected, and I'm just so glad that you guys did stay on. And thank you for listening to me tonight. I greatly appreciate you.
Thanks, Reed. That was awesome. Super helpful. We'll wrap things up in just a sec, guys. But real quick, if you haven't had the chance to read the Reddick Property Rating ebook, this is a really awesome tool. You can find it on the Learn page on our website. This is probably my personal favorite. It's like a quick 30-minute read our CEO wrote. It's just a great tool and a great resource. So for anyone that's not presently working with an advisor, this is essentially the process. Like we sit down and go over everything you're looking into end-to-end goal setting, looking at the different options, figuring out your time frame, selecting your criteria, looking at our different markets, and then connecting you with the team across the country, including Reed. So here's my info. It'll be in the follow-up email as well. But thank you guys all so much for coming tonight. We really appreciate it, and definitely looking forward to working with you all on your next loan transaction. So thanks again, Reed. Hope everyone has a great night.
Thanks, you guys. Have a great night.